Good afternoon. Good afternoon, everyone. Welcome to the Columbus Metropolitan Club. CMC connects people and ideas through community conversations and forums like this every week. I'm Deb Hackathorn. I'm the Government Relations Principal from Frost Brown Todd, and I'm also proud to serve as the Chair of the Board of Trustees of the Columbus Metropolitan Club. For those of you joining us today by live stream, we are coming to you from the Ellis in historic Italian Village here in Columbus. Welcome, everyone. If you scan the QR codes at your tables, you can learn more about today's forum, take a short survey, and see the many organizations that support your not-for-profit Columbus Metropolitan Club. Speaking of supporters, we are very grateful today for today's sponsor, Homeport. Thank you, Homeport. And we're also grateful to the presenting sponsor of our live stream, the Center for Human Kindness at the Columbus Foundation, and our live stream partner, the Columbus Dispatch, and of course, the Ellis for hosting us. Thank you for supporting today's forum. The Federal Reserve Bank of Cleveland, commonly known as the Cleveland Fed, is part of the Federal Reserve System, the central bank of the United States. The Cleveland Fed The Fed's not-so-modest mission to strengthen the economic performance of the nation and of the entire region. Since last August, Beth Hammack has served as president and CEO of the Federal Reserve Bank of Cleveland. She helps formulate U.S. monetary policy and oversees over 1,000 employees in the bank's Cleveland, Cincinnati, and Pittsburgh offices. They conduct economic research, supervise commercial banks, and provide payment services to other banks and the U.S. government. It is my great honor today to welcome today's speakers, Beth M. Hammack, President and CEO of the Federal Reserve Bank of Cleveland. Welcome, Beth. And our host for today's discussion, returning once again to CMC, award-winning news anchor, Clay Gordon. And we're going to stray just slightly from our normal routine because we've asked Beth if she would do a little Fed 101 before we get into the discussion with Clay. So, Beth, the podium is yours.
Okay, great. Thank you so much, Deb. I really appreciate being here today. I'm honored to join everyone here at the Columbus Metropolitan Club. I applaud the 13 Central Ohio women who founded this club with the goal of creating a space in which people from all walks of life could participate in meaningful conversations. A critical part of my role at as Cleveland Fed president is to understand what's on the mind of district residents and businesses and how they're experiencing the economy. So I will encourage conversation by keeping these remarks brief and sharing a little bit about me, the Cleveland Fed, what we do, and my outlook for the economy and monetary policy. As always, I will note that the views that I express today are my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. I'm a relatively recent Ohio resident, having moved here just last summer. However, my husband grew up in suburban Cleveland, and his family continues to call the region home. We've greatly enjoyed getting to know our new surroundings, taking advantage of the metro parks, and cheering for the Cavaliers and the national champion Buckeyes of The Ohio State University. As a full-time resident who has the opportunity and responsibility to travel around the area, I've been moved by how welcoming communities have been. There's no place like my new home. Before joining the Cleveland Fed, I worked in the private sector in financial markets for 30 years. One of the highlights of my career was engaging directly with policymakers and sharing insights with them. It was my interest in making an impact and the Fed's public service mission that attracted me to my current role. And while it's a horse of a different color, it is both thrilling and humbling to apply my practical experience to lead the Federal Reserve Bank of Cleveland in our work to improve economic well-being in the region and the nation. You may hear Cleveland Fed and wonder how exactly Columbus fits in. The Cleveland Fed actually represents all of Ohio, western Pennsylvania, eastern Kentucky, and the northern panhandle of West Virginia. That territory is the 4th Federal Reserve District Did I mess something up? That area. Should I keep going? Did I do something wrong? That area, no, I don't think it's going to, you want to try this? That area, does this pick me up? That area, this mic? Nope. This is the second time I've given a speech with technical difficulties, so at some point it's going to be me.
Well, I'm here to support you.
Appreciate that. I appreciate that.
We're working with the sound system. We're going
Okay.
to take a 2-minute break.
Okay.
We'll reconnect. If folks would like to grab a cup of coffee or a drink while we fix the sound, we'll get back to our conversation in just a moment.
That sounds great. Thank you.
Check. It's coming to us, but not there. Check one. I have plenty now.
Q&A mic.
The panel in the room, the XLR panel.
This one?
So one microphone?
I mean, no, they all work. It's just that the connection is wrong in the room. It should
Okay.
be
So
mic level instead of this. But I can do this if you want to just go.
All right, let's just go.
Carlos, you can bring it down.
Hannah, are you able to reset the room, get the rooms? This is test. 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 Is the podium mic working? Okay.
Mic check, mic.
No, we're great. Thank you. Thanks, everyone, for bearing with us. If this does happen the third time that I do a speech, then I know it's definitely me. So as I was saying, that area that we talked about, that's the 4th Federal Reserve District, one of 12 districts that were created more than 100 years ago as part of the third attempt to create a central bank. And the third time in that case was the charm. The authors of the Federal Reserve Act saw the need to create a central banking system rather than a single entity concentrated in Washington, D.C. or on Wall Street. What emerged is the decentralized public-private system we still have today, one that is uniquely capable of serving the nation's economic and financial interests, free from short-term political pressures. In Washington, D.C., the Board of Governors is part of the federal government, with 7 members who are appointed by the U.S. President and confirmed by the Senate. The 12 regional reserve banks are the operating arms of the Federal Reserve System. And although we were created by Congress to serve the public, the reserve banks are not part of the federal government. We each have a board of directors selected from regional leaders in the business, banking, and civic communities, and I'm honored that one of our directors is here today. The Fed's decentralized structure allows each reserve bank president to bring their district's unique perspective and on-the-ground insights into the nation's monetary policy setting process. That's part of why I and the team at the Cleveland Fed take the responsibility of traveling around the region and building relationships here in Columbus and elsewhere so seriously. It's our heart's desire to know how the economy is really working for people all around the district, and we start by looking no further than our own backyard. While setting monetary policy may be the best well-known responsibility of the Federal Reserve System, we have 4 other key functions. First, the Fed has a responsibility to promote financial stability, which was the primary reason for our founding in 1913. The Fed monitors the financial landscape for emerging risks while enforcing rules and regulations that aim to promote financial system resilience over the longer term. And in the case of a crisis, we have emergency tools that we can use to take action to contain the economic damage if a shock hits the economy. Closely related to financial stability is our supervision and regulation function. The Fed's Board of Governors sets regulatory policy, and the 12 reserve banks have been delegated authority to examine individual banks and other financial institutions to ensure they operate safely and soundly. At the Cleveland Fed, we have a team of examiners who evaluate more than 260 financial institutions across our district. These stable institutions provide valuable credit services to households and businesses and form the foundation of a strong financial system. Third is our support for the nation's payment system, where we ensure everything runs smoothly behind the scenes. As the Federal Reserve System, we run FedWire, electronic money transfers between banks and credit unions, check clearing, and other valuable services. In addition, the Cleveland Fed supports the U.S. government's payment services. If you've ever made a payment on a student loan or used a credit card to buy a souvenir at a National Park gift shop, you've touched applications developed and managed by the Cleveland Fed's Treasury Services team. Though cash and checks have given way to electronic payments in many cases, the Fed is continually assessing how much currency will be needed in the system as financial habits change. The Federal Reserve processes and issues paper currency to banks from its locations across the country, including in Cleveland and Cincinnati. A fourth responsibility is to promote consumer protection and community development. This work takes several forms. In supporting consumer protection, bank examiners at the Cleveland Fed and throughout the Federal Reserve System ensure that financial institutions follow fair lending and housing laws and that they are meeting the credit needs of low and moderate income individuals and neighborhoods as prescribed under the Community Reinvestment Act. To support community development, reserve banks work with partners and research topics like affordable housing, issues facing small businesses, and workforce development. The Cleveland Fed is home to several system-wide efforts around this function, including fedcommunities.org, which highlights the work of community development teams across the 12 reserve banks. That brings me back to the Fed's best-known responsibility, conducting monetary policy. Monetary policy actions are undertaken by the Federal Open Market Committee, or FOMC, which is made up of the 12 presidents of the reserve banks and the 7 governors at the Board of Governors in Washington, D.C. The 12 reserve bank presidents rotate voting years, apart from the president of the New York Fed, who is a permanent voting member and vice chair of the committee. Whether voting or not, all 19 of us speak, listen, and learn from one another at every meeting. Congress has given the FOMC a dual mandate to achieve maximum employment and stable prices. To do this, the FOMC considers a wide range of information to assess how close or how far we are from these goals and how likely the economy is to reach them. We generally meet 8 times a year, about every 6 to 7 weeks in Washington, D.C. Before each meeting, I spend nearly a full week with the Cleveland Fed's team of research economists to understand what the theoretical models, empirical data, and contacts from our district are telling us about the economy. I rely on this team to help me understand the impacts of various monetary policy approaches and pair this analysis with my reading of the signals that businesses, households, and markets are sending. Recently, the signals coming from these sources have been decidedly mixed. By many measures, the backward-looking data have been encouraging, but heightened uncertainty surrounding government policies is clouding the outlook and raising the risks of higher inflation and slower growth. The economy entered this year with solid momentum as real gross domestic product increased at a 2.75% annualized rate during the second half of last year. But the incoming data for the just completed first quarter point to a step down in growth as consumers and businesses have grown more cautious. National survey measures of consumer and business sentiment have declined, with many respondents noting policy uncertainty as a key factor. At the Cleveland Fed, we compile feedback from regional business and community leaders into our Source Index, which captures current and expected trends in the local economy. In general, our contacts report subdued economic activity. Many indicate that they have paused some spending in light of increased uncertainty surrounding government policies, including tariffs, immigration, federal spending, and employment. Looking at our maximum employment goal, the U.S. labor market has been healthy. The unemployment rate was 4.2% in March, a relatively low level, and similar to its readings over the past 12 months. with solid job gains through the first 3 months of this year. However, on our inflation objective, there is still more work to do to return the economy to price stability, which the FOMC defines as a 2% inflation in the Personal Consumption Expenditures Price Index, or PCE inflation. Headline PCE inflation was 2.5% through February, and core PCE inflation, which excludes the volatile food and energy sectors, was somewhat higher. Both measures are likely to move down once the March readings are released to readings that are still somewhat above our 2% goal. But much of this hard data is backward-looking, and we as policymakers must consider the possibility that we may not be in Kansas anymore. Over the last 2 weeks, changes in tariffs have figured prominently in the news. On net, the tariffs that have been put in place constitute a substantive change in trade policy. It will take some time for the overall economic effects of these recently enacted and other proposed changes to government policies to become clearer. In recent weeks, financial markets have been volatile as they incorporated this news into various asset prices. Thus far, financial conditions have tightened on net, as major equity indices have declined, credit spreads have widened, and longer-term interest rates have increased. At the same time, the dollar has weakened against a basket of foreign currencies. This pattern is different from recent risk-off episodes in which equity prices declined, credit spreads widened, the dollar appreciated, and U.S. Treasury yields fell as domestic and international investors sought the safety of U.S. government bonds. My staff and I are updating our assessment of the path ahead based on the incoming economic and financial data alongside anecdotes from the district. From what we've heard so far, uncertainty surrounding the outlook is high. I see risks around both legs of our dual mandate that could lead to higher inflation outcomes and to lower growth and employment outcomes in the near to medium term. This is a difficult set of risks for monetary policy to navigate. Given the economy's starting point, and with both sides of our mandate expected to be under pressure, there is a strong case to hold monetary policy steady in order to balance the risks coming from further elevated inflation and a slowing labor market. When clarity is hard to come by, waiting for additional data will help inform the path ahead. With inflation elevated, the current modestly restrictive stance for monetary policy is appropriate to continue the downward pressure on inflation so that it returns to our goal in a timely fashion. If the economy should falter and inflation decline, then it may be appropriate to ease policy by lowering the federal funds rate from its current level of 4.25% to 4.5%, perhaps even quickly. If the labor market remains healthy and inflation moves up persistently, then monetary policy may need to follow a more restrictive trajectory. But if elevated inflation is paired with a slowing labor market, then monetary policy will face some challenging trade-offs. In that case, it will be important to ensure inflation expectations remain well anchored while assessing the likely magnitude and persistence of the misses to each side of our dual mandate goals. Unfortunately, my crystal ball only shows the present, so we will simply have to wait to see how events unfold. I would rather be slow and move in the right direction than move quickly in the wrong direction. Setting monetary policy takes heart, brains, and not a small amount of courage. Fortunately, I think we are in position to assess the incoming data, the risks to the outlook, and the appropriate policy response to achieve our longer-term objectives. If only the path to meet both parts of our mandate was as clear as following the yellow brick road. The more I learn from and listen to the people who live and work in the region, the more I continue to be impressed by a strong spirit of collaboration. Whether I'm participating in a roundtable in Columbus, touring a construction project in Pittsburgh, or learning about the equine industry in Lexington, I see the same commitment to making sure our region is vibrant. I hope all of you take away from my remarks that the Cleveland Fed is a resource for the communities we serve and that our employees are of these communities. So here's my ask for all of you. Please get involved with the work that we're doing at the Cleveland Fed to thoroughly represent all parts of the district, including right here in Columbus. We have many opportunities to make your voice heard. For example, we need people in our business communities to serve as Beige Book contacts and advisory council members. We're also looking for insights from community organizations on barriers to joining the workforce. You can find more information and ways to work with us on our website, clevelandfed.org. I'm looking forward to making today's event a conversation and hearing your insights and questions. So thank you very much.
Did everyone get all that? We're going to break down a lot of those topics that you mentioned too, because it's, I think everything that you mentioned is fascinating for a lot of people in the room here too. But my first question to you, Beth, and we appreciate you being here at CMC, is what role does the Cleveland Fed really do in a Central Ohioan's life, daily life, day-to-day basis? What really is that role?
So as I talked about, it's multifaceted in terms of how we're engaging and how we're impacting the lives of every Ohioan. The easiest thing and the one that I think is fun and most tangible is if you take out a dollar bill from your wallet, and on the $1 bill it has a circle. If it has a D and a 4, that means that it was processed and issued in Cleveland. That comes from the bank and from the region. Each one of the banks has its own code on it. And so I know people aren't using currency as much as they used to. They're mostly keeping currency, particularly offshore. Currency growth has continued to rise. But I think that's a fun and more tangible thing that we do. The other work that we do is really around trying to make sure that the economy is working for everyone. Really trying to understand what are some of the barriers to entering the workforce, what are some of the hurdles, how do we help break those down and make sure that every citizen can really participate in the economy overall.
And you kind of mentioned it off the top, but you do talk to business leaders, organizations, you travel around your region. How often do you travel around? And I know you put out the ask to get involved with being a Beige Book contact. If someone is listening to this or seeing this and they think, well, maybe my opinion doesn't matter, why does it matter?
Every opinion matters. I mean, we need to really have a 360-degree view of what's going on at the economy. So whether you're a large multinational business, whether you're a small local business, whether you're an individual who's looking for work, who's trying to figure out how do I move up the food chain, how do I get a better paying job, how can I change my economic circumstances to provide for my family. Every single one of those perspectives matters to me and matters to the FOMC in how we think about setting economic policy.
And give me an example on one of your tours to your different cities, different areas. Who are you talking to? What are you looking for?
So this morning, I'll give you the example of today. So this morning we met with our Business Advisory Council in Central Ohio, and there was a mix of businesses from the chamber who was there, as well as some housing developers, some builders, some retail companies, some quick service restaurants were there, giving us, there are different perspectives on how they're seeing the economic picture right now. Obviously, there's a lot of uncertainty. That was what theme that we heard this morning, and I think we'll continue to hear over the next couple of days and weeks. But one of the things that we ask and we really try to drill into in those conversations is how are they thinking about pricing? How are they thinking about business growth? How are they thinking about making investments in the region? Because it's those individual stories, particularly at a moment like right now, where the data that we have, which has been really strong in the first quarter, might be backward looking, and we need to really understand where we're headed. And so the data that we have, because it takes a long time to process and work through, may not be sending us the most up-to-date, accurate signals. And I find these conversations, though they're anecdotal, there tend to be themes that come out of it that can help give us indications of where the economy is going.
Tell us a little bit more about the data and research too. I believe what I've heard is you like talking about the research and some of the proud moments that you see in our region. So here in Central Ohio and in our region, what are some of the good economic factors that you're seeing, and how could we support that as business and community leaders?
Yeah, so one of the things that has impressed me most in traveling around Ohio and the region generally is just the level of collaboration amongst the business communities who really are supportive of one another. It's not a feeling of extreme competition. It's really how do we help make our cities more vibrant? And the region is an interesting one because we have a number of these mid-sized cities, whether it's Cleveland, Cincinnati, Columbus, Toledo, Akron, Pittsburgh, Lexington, like all of these cities are to a certain extent dealing with similar problems of how do we revitalize, how do we get people here? And really what's driving that is more of a demographic shift, and that we're not creating as many new people in the next generation, although I hear you're hard at work, so that's good. Thank you for that.
We're done, by the way.
So you think.
After 2.
But that's been an issue, is to make sure that we have, some of the issue that I hear when we talk about employment in the region, one of the consistent themes I hear from a lot of employers is that they need more people. And it's not because we have a 0% unemployment rate, but it's because we just need more people in the region to come in and fill those jobs. And so you do find in areas like Columbus and Cincinnati, which are some of the brighter spots in the district, that you have lower employment rates than you do in the Ohio and the national average.
Yeah, and I was going to say, how does that compare to the other Fed banks regions?
Yeah, so we have analysis. Our data covers the whole 4th district that we have. My colleagues at the other reserve banks will have similar statistics for their areas, and it just depends kind of where you are in the country. One of the areas that's seen the most growth, the most persistent inflation, the most continued investment has been the Dallas Fed. Their region really encompasses a lot of Texas and parts of Louisiana, I believe, in that area. So that's one of the areas that has been really strong.
So you've been in this role, this new role, for about 8 months now, and you've had a front row seat really the last part of the year in 2024 to rate cuts. So what was it like with those 3 rate cuts at the end of the year, being in the room where it happens, and really your first 3 months or 4 months as in your role? What was that like?
It's humbling. My first meeting was a September meeting where we cut rates by 50 basis points. So I walked into the job on August 21st. Day 2, I flew to Jackson Hole because we have a conference of policymakers and researchers talking about a lot of academic work. So that was day 2, to be with all these other central bankers and out in Jackson Hole, which was fantastic. And then 3 weeks later, I'm in the FOMC room in Washington voting, because in 2024 was a voting year for Cleveland, having to vote for whether or not it was the right thing to do to ease policy for the economy and sort of put my views out there. So it's really an awesome responsibility. I take it incredibly seriously. I think it's really important for each one of us at that table to bring our own unique perspective and to really represent the area that we're from. And that's part of why being out in the district and talking to people is so important, because I want to make sure that things come alive when I'm at that table. The data, we're all looking at the same national data. We're all, looking at the same stories, reading similar research. But I think what really resonates in the room are these stories. And they may be anecdotal, but we get some really colorful commentary from a lot of our contacts, and that helps to make things come alive and help really tell the story of how individuals and businesses are experiencing things.
Was there a learning curve going from the private financial markets to the financial regulatory field?
It's different, yeah. It's definitely different. The pace of it is different. You want the pace of it to be different. When you're in financial markets, you're making decisions at a rapid fire pace because that's what's expected. But you can get into and out of any one of those choices reasonably quickly if you're in the securities markets. When you're making monetary policy decisions, the ramifications and the implications of those are much, much greater. And so you want to move more slowly. You want to be more deliberate in how you're thinking about the ways that you're setting policy and what those implications are going to be. So getting used to that pace was definitely different. I'd been, in the markets, I'd been engaged in watching the Fed for a long time. And one of the highlights of my professional career was being able to serve on a couple of committees for both the Department of Treasury and the New York Fed. And so I had a sense of how policymakers worked, what they thought about, what some of their views were. So parts of it were hard and parts were easy, but I have an amazing team at the Cleveland Fed who has really helped steer me well and make sure that I'm considering all the different angles as we are working on these issues.
You said some of the financial markets are rapid fire. I think we're experiencing that really in the last 3 weeks. So interest rates really have dominated the headlines. And then even more so now is this kind of tariff takeover that we're experiencing. So how do you balance the slowing inflation and not stalling the economy, especially when the factors and the data come in almost hourly at this point?
There is a lot of information that comes in. We try to be methodical in how we process it and how we think about it. And we don't respond to the financial markets, and certainly not every up and down and every print that goes on. That wouldn't be appropriate for us. That's not what matters. What matters from the financial data is the impact it has on businesses and households and on their investment decisions and how they're thinking about their choices. So this morning we were talking about, with interest rate moves, how is that impacting businesses looking to make bigger picture investments in the Columbus region? Are multinational companies still thinking about coming here as they're looking to make, build really big facilities, billions of dollars of investments? How do the level of interest rates, how are the tariffs, how might that impact those choices? Similarly, if you're talking to individuals, interest rates, mortgage rates are going to impact how they think about buying a home, what size of a home they can afford. And so all of those different pieces are why we care about the financial markets. It's not for the markets per se. I'm sorry, but I don't care how much money is in anybody's 401k, maybe other than my husband's. But away from that, it's really about just what are the impetus that's going to come from all of those from all of those signals.
You mentioned uncertainty too, and one of your tasks with the Fed, obviously, is monetary policy. The other is job growth. Tariffs impact both of those. So with having the conversations with Ohio businesses and our regional businesses, what are the next steps kind of moving forward with, some of these political pressures?
I mean, in my role, the job is really just to understand how the economy is developing, to really get a clear picture, or as clear a picture as anyone can have, around what those signals are doing to individual businesses and family choices in terms of how they're engaging in the economy. And it's going to take time. It can be frustrating to see sharp movements in financial markets, to see these strong headlines and different policies that are coming out. And the right thing for the Fed to do at this point might be to stay on hold and to leave rates where we are. And that doesn't mean that we're ignoring everything that's happening. We're watching very, very closely, and it is an active choice for us to keep policy where it is because we think it's the right level to keep pressure on inflation, to keep it headed down towards our 2% objective. But also we don't know what the ramifications of all of these policies is going to be, and we need to really look at them holistically. So tariffs is one, but there's spending and there's fiscal fiscal packages that are coming forward. There's been talk of deregulation. There's immigration policies that are out there. We really need to look at these across the board and understand what the impact of all of those are going to be, what the net effect is going to be on the economy broadly.
The Federal Reserve is famously independent from politics. How do you guys navigate current situations, past situations, staying independent when there is a lot of outside pressure?
It's really important for us to make sure that we are focused on the American people and all of the American people. We are not party aligned. We are completely apolitical. We live through many different administrations. The terms at the Board of Governors are 14 years. I think the average president's term is somewhere around 10 years. So we really live through multiple cycles. And it's important that we have that long perspective in mind, because when you have a central bank that's independent, you tend to find you get better economic outcomes for those countries. So if you look around the globe, there are some central banks that are not independent. They're more subject to political pressures, and you tend to find higher inflation and lower employment in those countries. And so it's really important that we fiercely guard that independence, and we make sure that we're able to make the right long-term decisions for the public.
So I know you said earlier that your crystal ball is pretty much stuck in the present, but let's talk 6 to 10 months out. What are you thinking, and what would really change your mind from a pause that we're experiencing right now?
I mean, the crystal ball really does only show the present, so there's really nothing to see 6 to 12 months out.
We might have to fix the crystal ball.
When things are uncertain like they are now, one of the helpful things to do is to really think about scenarios, right? Rather than try to come up with what's a base case for a point that far out, given everything we're experiencing, it's really helpful to think about different cases of how the economy might unfold. And so, if tariffs were going to be, there's a possibility that the tariffs could be like a one-time instance, similar to what we saw in 2017 and 2018, which rose the price level but didn't have persistent inflationary effects. It could be that the tariffs are going to be more of this back and forth round robin, more retaliation, and those types of movements could create more pressure on inflation and give us elevated inflation. It's possible that some of the other policies, could weigh on growth, could weigh on our businesses' ability to continue producing, and that could feed through into employment, and we could see weakness in the employment side of the picture. And so we really just need to look at each of those cases, because I don't know where we're going to be. All we can do is try to make the best choices with the available information that we have, both the data and the anecdotes and the conversations from all of our colleagues and friends around the 4th District, to try to make sure that we're making the best judgments possible.
So really one meeting at a time?
One meeting at a time. Yeah, I go into every meeting with a really open mind. The week before the meeting, obviously the team and myself were out there talking to people in the district every 52 weeks of the year. That's the job, is to really be out there and understanding how people are experiencing the economy. But we spend a pretty intense week, the week before the FOMC meeting, with my research team to really unpack what the data says. We go through some interesting, one-off topics or different, pieces of analysis to do a deep dive into some area and really unpack kind of what models would tell you makes sense. And then we couple the theory with the practice. I grew up as a practitioner, and so it's helpful to me to try to understand how are actual business leaders think about this? How are they going to make their individual decisions? Because one of the things that I'd always observed is that the models and the theory is great, but then you get into practice and it works completely differently. And so making sure that we're bringing both of those together to understand what the right choices are.
I've always been so curious about the preparation for one of these meetings, and I'd like to believe that Jerome Powell comes out 15 minutes before with a brand new decision. But when is a decision actually made? You said the week out is very intense. Does it come down to the 11th hour?
We go into the meeting with, you can see this, we publish on a 5-year lag. You can see all the materials that we use for the meetings. And so the staff at the Board of Governors in Washington puts out what we call the Teal Book, which is like a, 250-page book of all the economic data, how they're seeing the domestic economy, what their projections are for where things are going to head, what's going on in the international economies that might impact us in the US, what some of the financial markets have been interpreting, and then a series of policy choices. And so there's a range of choices that are kind of on the table that we're thinking about at any given meeting. When we go into the meeting, each participant goes around the table, and we break it into kind of 2 sections. One is, what's your view of the economic outlook? And then the second section, which is usually on the following day, is going through what do you recommend for policy at that point in time. And everyone is really talking and listening and learning. And many people will kind of write their thoughts down in advance and read them forward, but you see people updating and editing their remarks while you're in the room and reacting to things that other people are saying. And there's casual time, like at any meeting. There's casual time away from the formal process where you're talking to your colleague and saying, wow, that was really interesting. I hadn't heard that. Where are you hearing that? What do you think that implication is? And try to really put those things together to make sure that, all of us have the same goal. The dual mandate goals of maximum employment and price stability. And we walk in that room, each one of us, trying to make sure we can do our best on that. And we might have different perspectives because we come from different vantage points. But I think that's one of the strengths of our system, is that we have 19 different perspectives that are brought to bear to make sure that we're really having a robust discussion.
Well, Beth, this has been a fantastic discussion right now, and I do want to say we have time for one more question from me, and then we're going to take some questions from the audience, and then some live stream questions as well, too. So I want to just learn a little bit more about you, kind of what makes you tick. What do you like to read? I heard you're not a podcast person, so what do you kind of do first of all, where do you get your financial news from, and then all the way down to how do you unwind at the end of the night?
So I don't really do podcasts because I've got a 12-minute commute, which doesn't really lend itself well to podcasts. And when I'm exercising, I like music, tends to relax me more than podcasts. But I do read. I read the 250-page Teal Book. So when I'm not reading that on the FOMC cycle, I tend to read more fiction. Ann Patchett is a favorite writer. I've read a bunch of her books. Tom Lake was a recent one. I just finished Kristen Hanna's The Women, which is about women who served in Vietnam, which is a fantastic book. If you haven't read it, I highly recommend it.
And as a former broadcaster, do you watch?
Where do I get my news from?
Yeah, do you watch the CNBCs, the Bloombergs? Do you watch the Fox Business shows? Where a lot of people on TV are constantly talking about the financial markets, or do you kind of stay away from a lot of the noise?
I listen to it. It's important to hear what the dialogue is. I don't respond to it minute by minute. It's not like I'm staring at the TV all day. That's not the goal. But I do pay attention. I'd say Bloomberg, CNBC, the Wall Street Journal, the Financial Times, The Economist. There are a number of publications that I try to keep up on. And then, of course, getting the regional news. So Cranes, the local Cranes news across Ohio is helpful. The Dispatch here, the Plain Dealer in Cleveland. So just making sure that I'm getting sort of a flavor of what's going on around the area.
Well, Beth, thank you so much for taking my questions right now. I want to turn it over to Doug Buchanan, who's in the back of the room. So if you have any questions, think of them now. And then, Doug, it's over to you.
Clay, thank you very much. Beth, thank you very much. And thank you, everyone, for your patience while we dealt with our technical issues today. We really appreciate that. If you have a question for Beth, please do join me here at the microphone. If you're watching online on YouTube, type your question into the chat. We'll try to get to as many of them as possible. Great questions at CMC always have 2 things in common. They take 30 seconds or less to ask. And what punctuation mark does a question end with?
Question mark.
It ends with a question mark. Yes, thank you very much. Thank you. I'm going to launch us off with this one. In a recent interview with NPR, your colleague at the Chicago Fed, Austin Goolsbee, talked about something ominous called the stagflation impulse. Can you speak to what that is and whether or not we should be concerned about it?
So I have not yet been able to listen to that Wait, Wait, Don't Tell Me episode. It is downloaded for my drive back to Cleveland this afternoon, so I will get the full details on that. A stagflationary impulse is really what I was talking about as one of the possibilities with the tariffs that have been introduced, which is that you have a lower growth outcome and you have a higher inflation outcome. Typically, those two things are moving against our mandate. A more typical environment is when you see a lot of inflation, when you see high inflation, like we saw in 2021 or 2022 coming out of the pandemic. It was because there was a lot of momentum in the economy, there was a lot of growth, there was a lot of investment. You saw employment really low at that time as well. And so those two things are really kind of moving in the same direction. And in that type of an environment, it's really easy for monetary policy to know what to do. We had high inflation, we had low employment. We said, whoa, we need to put the brakes on. And so what you saw the FOMC do was raise rates to try to put a little bit more restrictiveness in the economy. As we got into 2024, coming out of all of that, as the picture had really healed, you saw a little bit more pressure on the employment side. You saw inflation starting to come down to target. Growth was pretty steady. And so we said, you know what? We've been at this really restrictive place. We can take some of that restriction out of the economy. We lowered rates. When you have a stagflationary impulse, which is lower growth, lower employment, and higher inflation, it's not clear what you're supposed to do from a monetary policy perspective. And so what the key for us will be is making sure that inflation expectations stay well contained, because if those get unanchored, that could lead to much more persistent inflation longer term. And then we need to look at what is both the magnitude and the persistence of the miss for each sides of our mandate. So are we missing by more on the employment side, or are we missing by more on the inflation side? How long do we think those are going to last? Will they be transitory, temporary, or will they be persistent? And factor that in when we're thinking about what the right posture of policy is.
Hi, I'm Bill Lafayette. I own Regionomics. And I've been very concerned about the tariffs, and I'm just wondering what your folks are telling you around the district. What do they see as the specific impacts of the tariffs here in the 4th District?
So right now, the main thing that I'm hearing from businesses is just a level of uncertainty. I think most businesses are trying to understand how the tariffs are going to impact them, what the final tariffs will be, given that we're in a pause on a number of those tariffs right now. They're trying to think about longer term investment for the business and what the right choices are for them in terms of how to invest. Should they be moving their supply chains more domestically? What will the implications be if they don't? What's the pricing power that they have right now? What are their competitors' pricing power? Some businesses that we've talked to who aren't impacted by tariffs have said that because their competitors are impacted by tariffs, those prices are going to go up, so they may take advantage of that and raise prices as well. That's something we need to monitor carefully. But for me, as a policymaker, my job is, I don't have an opinion about the tariffs, good or bad. That's not up to me. That's up to the administration to decide what the right policy is. What we're doing from a monetary policy perspective is trying to figure out how do we navigate these types of issues when they arise, and what can we best do to help meet our dual mandate goals of maximum employment and price stability.
Hi there, Greg Wayna, live in Dublin, Ohio. My research is very limited on you in terms of just looking on LinkedIn, but I applaud you for a very blue ribbon career. Your LinkedIn identifies a 5-month career break, and I was just wondering how that 5-month career break helped you on day 2 when you landed in Jackson Hole.
That's a great question. If I'd known it was going to be a 5-month career break, I might have done different things through that period. I got to rest and recharge, which was great. I did some traveling with one of my children. We got to go to Asia for 3 weeks and kind of see a different part of the world. I always find that traveling and getting insights from other people, other perspectives, other cultures is really helpful for me in just understanding and putting into perspective what we have here.
Hi, my name is Jan Ras-Friedman. I'm a repeat founder here in Columbus. Given the global uncertainty, both economically and now with the tariffs and just the broader administration policies, what are some of the specific critical levers that the Cleveland Fed has to use over the coming decade to ensure inclusive and sustainable growth across the 4th District?
Yeah, so one of our roles is in community development that I talked about. It's really working with a lot of the organizations, nonprofits, and others, community-based organizations across the 4th District to understand how they are engaging with populations. And we tend to focus on 3 main areas. One is around the affordability of housing, the second is on small businesses, and the third is on workforce development. And so we're out in the communities trying to get to know what are different organizations doing? What are some of the exciting things that are happening that are helping to move and upskill our population? So after this today, I'm going to go to COSI, and I'm very excited to be with Dr. B, and see some of the really exciting work that they've done both around workforce development, around financial literacy, and around science and STEM education. A couple weeks ago, I was at Lorain County Community College, where they've been engaging in a program where they'll work with local businesses to figure out what it is they need for their workforce, what types of technical skills they need. They'll put you in a 16-week program where you'll come out of that with a job that you know you're going to have that you've been skilled for directly. And there's a pathway to getting an associate's degree and a bachelor's if the person wants. So it really moves them through and up that value chain. And so we're trying to find those types of really exciting programs and try to help amplify what they are, connect people across the district, across the country with different ideas so they can help to amplify them and kind of replicate some of the things that are working. In June, late June, we will host the Policy Summit at the Cleveland Fed. This is a conference that we hold every other year on behalf of the whole Federal Reserve System. We bring together community leaders and policymakers from across the country to talk about some of these exciting things that are happening and try to make sure people are sharing ideas.
Beth, thank you. Recently, U.S. Treasury bonds fell in value at the same time stocks did, which is generally not supposed to happen at the same time. Wondering what your take is on this and whether you think it means investors might be losing faith in the economy or the U.S. economy.
So I'm no longer a market participant in that way, so I don't really try to interpret those types of the signals. What I do with the market data that we see is I really try to understand what that impact is going to be on households and businesses. And so typically what you've found historically is that when equities rise, you tended to find that yields would go up because the economy was really robust. And so having this movement now where you saw equities falling and interest rates rising is somewhat of an anomaly. I don't quite know what to make of it particularly. And again, as I said, the financial market data is something we watch just to really understand the impact it's going to have on households and businesses rather than anyone's individual portfolio.
Reverend Howard, are inflation expectations well anchored right now? And what are the key lessons from the 2018-19 episode with trade policy uncertainty?
It's a great question. It is something we're spending a lot of time to unpack. The market-based measures of inflation expectations, the TIPS securities that we tend to look at have been very well contained. They've been in the low 2% and very steady in that range. There has been more movement in some of the survey-based measures, the Michigan indicators, the New York Fed's indicators. Certainly in the one-year sphere, you're seeing more elevation in some of those expectations, but the longer-term ones have been reasonably contained. But again, some of these surveys take place over March rather than April, and so we'll need to keep watching the data to see how things are performing. But at this point in time, it still looks to me like things are reasonably close to where we want them to be.
Thank you. Nancy Nanny asks, do state and national politicians pay attention to what the Federal Reserve discovers? Now, that might be in reference to their research.
We do talk about the research. I meet in my role with politicians just to help them understand and to help me understand. We sort of share information on how I'm seeing the economy, how they're seeing the economy, what they're hearing from district members, and we try to share information. And so when we have interesting research, we make sure that we're sharing that broadly with different leaders. We did a bunch of work earlier this year and late last year on some of the flooding in eastern Kentucky and some of the problems that was creating, how that might impact workforce, how it might impact people's ability to get back into the workforce and hold jobs. So we try to share as much information and our research with the public officials as possible.
Carol McGuire, I'd like to revisit that, the bond situation for a moment and the international impact that things are having. I mean, we know that Japan has large investments in this country in the way of bonds, and we've heard some negative kinds of comments coming from any number of those countries. How much of an impact does that have on the monetary policy that the Fed considers?
For monetary policy, we really need to be forward-looking, and we really need to think about the long term. So we have one blunt instrument, which is control over the federal funds rate, which is the short end rate of the curve. We don't control the long end rate. We don't control yields further out the curve. And so what we do is both through that policy rate, through our communications, and to some extent through our balance sheet, we try to make sure that we're steering the economy towards our dual mandate goals of maximum employment and price stability.
Roger Blackwell asks, how does the Fed consider long-term effects as well as the short-term effects, specifically of tariffs?
We're trying to look at both the near term and the long term. So our picture really is trying to steer the economy over the medium term, really. I don't know, I guess we can define these different terms, but over some intermediate period to make sure that we're continuing to hit our goals. There can be, short-term impacts from tariffs, usually would be price level increases. Longer term, we need to think about that longer term impact, because if the tariff is just a one-time move and it's a price level, then we don't want to over-respond to it, because that's not inflationary. Inflation is the rate of change of prices rather than the level of prices. And so if the rate of change is not steadily increasing more than our target rate, then we don't really want to react to that too much. And so for us, it's less about the short-term impact, it's more about the medium to longer-term impacts of what these policies are and ensuring that we're setting policy correctly to accommodate.
Thank you very much for being here today. I'm Amy Claiborne, president of Families Flourish. Maximum employment is a great goal and very important one. 42% of people here in Franklin County are cost burdened. They can't afford their housing. Wages are just not high enough. So are there levers that the Fed can use to address this issue? We've got to get wages up so people can actually afford all the things they need for a decent life.
So we are, as we've talked about, continue to stay in touch with the overall picture. And I think what you're saying is very much in line with what I've been hearing from a lot of my contacts, which is that we've got a two-speed economy. People at the upper income spectrum are doing incredibly well. They're spending, they're continuing to keep growth moving, certainly through the end of last year and the beginning of this year. But at the bottom end of the spectrum, at those low and moderate income families are really feeling the pinch. They're feeling the pinch from higher food prices, from housing prices, and they've really been struggling. And so we take into account both sides of that, both sides of this two-speed economy as we're looking at setting policy to make sure we can be as supportive as possible. Away from that, I'd say we continue to use our resources from the community development side and work with partner organizations to understand what can be done. And it's not necessarily for the Fed to do, but we use really our convening power, and we use our insights and our research staff to help study what different areas are doing about affordability of housing and how we can help to ensure that that individuals have access to good, safe, clean housing.
Thank you. We have just a couple minutes left for one final question. The health of a local economy depends on how well sectors, public, private, nonprofit, work together. From your vantage point, what are some of the most promising examples of cross-sector collaboration you've seen across the Cleveland Fed District? And you mentioned your collaboration potentially with COSI. So what are some other collaborations that you see that are producing great results?
Yeah, that's a great question. There are a couple of things that I'd say. One is, I talked about Lorain County Community College. Another one I'll point out is we went to visit the Cleveland Food Bank, which is primarily helping with food insecurity, but they've created now a community resource center, which has essentially an outpost of Jobs Ohio, of some housing providers. They've got a Metro Health clinic. They've got a whole series of other services, wraparound services in the same facility. So you come in because you're hungry, but they say, what brings you in today? And they ask you and try to help you, point you in the right direction of finding all the different services that are available so that you can take advantage of those. I think one of the things that we hear very often is that, if you have to go over here to work on your employment or upskilling area, and then you have to go over here to get food, and you have to go over here for health, and you have to go somewhere else. All of these places have long lines. They're only open during business hours, so it means you have to take time off your job. And so by putting all of these resources together, it's really creating a full service model for the low and moderate income population to really help support them. We saw something similar in Cincinnati in the Brighton Center, where they're doing something pretty similar that's organized more around workforce development, but they are also working on childcare, they're working on housing, they're working on other aspects of what can keep you as a barrier from being in the workforce. So those are a couple of things. I'm really excited to see COSI today and to learn more about what we're doing here in Columbus.
Well, you're going to love COSI. Enjoy every second. And you said you're going to switch shoes to walk
switch into
around.
sneakers, yes. Okay. I will have appropriate shoes for that.
We really appreciate everyone asking questions to the microphone and on our live stream. It's been great to hear what you have to say. As I conclude, I just have one quick little question, and I know your term is just getting started. What do you picture, if you could pick a legacy at the Cleveland Fed, what would that look like?
If I could pick a legacy for me at the Cleveland Fed, what it would be is that when I leave the Cleveland Fed, and it's weird because when you take this job, you kind of know your retirement date, so that's a little bit awkward. But when I leave the Cleveland Fed, what I would like is that anytime there's a big issue, a big concern, a big problem that's happening in the 4th District, people pick up the phone and say, gosh, I wonder what the Cleveland Fed would say about this. What information do they have? What resources, what insights do they have available that can help us? Who can they connect us to within the district? So I'd like people to know who we are, know all the resources we can bring to bear, and I'd like for us to have that depth of connectivity within the region most broadly.
All right, I'd like to turn things over to Deb Hackathorn with some final remarks here.
Thank you.
Well, I hope you're going to walk away having learned a great deal more about the Cleveland Fed, how engaged they are in this region, how much they want to learn from you and your businesses and the organizations you're involved with. So we very much appreciate learning that. I also think we'd all like to join Beth's book club based on her selection, so sign me up for that. Thank you so much to the sponsor of today's forum, Homeport. And we also are so grateful to our presenting sponsor of our live stream, the Center for Human Kindness at the Columbus Foundation, and our live stream partner, the Columbus Dispatch, and of course the Ellis for hosting us. And a very special thank you to our guests today, Beth Hammack and our host, Clay Gordon. Please do make plans to join us next Wednesday right here at the Ellis for Advancing Together, Meet the Columbus Partnership's new leader. Thanks to everyone. We couldn't do this without you. Have a wonderful afternoon. Love the shoe.